Good afternoon. Wanted to give everybody a quick market update. We're watching volatility continue to persist. This is happening for a number of reasons, and the market has continued to stay flat and slightly negative since reaching its lows last month. It's possible that we may see the market test its lows again and potentially even move lower. During a time of recession, if that is in fact where we're headed, the average market retraction is about 30% leading into it. That very quickly can recover, but that's the average that we could expect to see have happen. Most people do believe that a recession is possible, and if it's going to happen, it's likely going to happen in the second half of next year, although some are saying that maybe we're in a recession right now. However, the interesting thing is that ever since the pandemic, it's been very hard to forecast and predict market and economic events. So we have a really healthy consumer, fiscally speaking. We have low unemployment. We have the highest, fastest wage growth that we've had since the 1980s. And yet the market continues to sell off because of inflationary data staying high. Although it does look like we are getting some reprieve in that, in gas prices and other prices starting to come down just a little bit. I think it's possible that we start to see a stabilization. There's a school of thought. Most people think that by the second half of this year, we'll start to see leveling of the consumer price index, and that the market will likely continue to move back to the positive. Be careful watching news and just reading headlines, because headlines rarely are the full story. So I encourage you, if you're watching the news or if you're reading a headline that catches you off guard, read the article in its entirety. It's important that you understand what they're actually trying to say. I'll use this as an example. Here not too long ago, Jamie Dimon, the CEO of JP Morgan, was quoted as saying, "We're going to have an economic hurricane." Now, I don't know what an economic hurricane really is, but what he was trying to say, if you got into the article and you read the article, was that, hey, we could be going into some rough periods. And he went on to say in the article, he didn't know if the storm was going to be bad or if it was going to be a small storm, right? We cycle through economic events on a regular basis. That doesn't mean that it's a horrible thing, right? But when we hear headlines like economic hurricane or market crash, which again, as we've said before, there is no way to define a market crash, right? We are in what's considered a bearish market right now. Anything that's down below 20%, which the market's dropped roughly about 21% since the beginning of the year, is considered bear territory. Can that persist? The answer is yes, it can persist. But could it very quickly turn and move back to the positive? The answer to that is also yes. We only need to look back to 2020 at how quickly we rolled through that bear cycle. Understand that in today's environment, we have a lot better handle on what's happening than what we did even in 2020. 2020 was a very unusual experience for us. It was the first time in the modern era where we shut down our economy because of a pandemic. The demand for gasoline was really low during that time as well. Now we have a really healthy economy on a lot of levels. Although we're seeing maybe some pullback in our GDP numbers, we have a very healthy consumer. Wages are increasing, unemployment is near all-time lows, and consumers continue to spend despite rising prices in fuel and food. So those are the things that we're watching. And it's almost as if good news is becoming bad news. Because the better the news on the economy or the consumer, the more aggressive the Fed's going to have to be to try to slow the inflationary numbers down. But it looks like that it's working. The most recent inflation data suggests that while inflation remains high, it's not as high as what it was a month ago, and so on and so forth. So we're seeing a stabilization in certain things. Housing, we're seeing more homes stay on the market longer. So the supply of housing is increasing. That should help control some of the prices. Interest rates are slowing the demand for 30-year mortgages right now. We go through times like this on a regular basis. And while this time may have some nuances that are different than past events because of us coming out of the pandemic, all right, the reality is that given enough time, we know that things are going to be just fine. We know what the end game is going to be, right? We're not panicking. We're not selling out, right? If investing were as simple as buying when things felt good and selling when things felt bad, I wouldn't have a job and we'd all be very successful at it. But the reality is it's just the opposite. It's holding on when things don't feel good at all, when it looks like that there's no hope or that this is the end. But the reality is that's not likely going to happen. Unless we think that the business sector is going to stop working and that the financial system is going to seize up, at which point our money's worthless. It doesn't matter if it's in the bank, doesn't matter if it's in our investments, it's all worthless. But that's a low probability event. It's not likely going to happen. So be careful falling victim to that kind of thinking. What we want to do is make sure that we're lined up with our long-term goals. And when I say long-term, we're talking a 3 and 5 year period. And we want to make sure that we're on track with those. In most cases, we still are. While portfolio values have come down, the other important thing that I want you guys to remember is that you're not the S&P 500. So when we talk about the market going down 21%, that doesn't mean that that's your portfolio. In fact, most of our clients, that's not the case. So understand that you're staying above the market. That's what diversification does for you. We have quality and we have good diversification in our portfolios. And we know that given enough time that those things will likely continue to appreciate. So we want to focus on what those long-term goals are. And we want to be careful not to fall into the idea that there's a one-size-fits-all approach, that there's a magic investment that somehow makes everything better, or that we start trying to chase performance. Remember, performance is only an act of staging a play to entertain you. We want results, and results are the consequences of actions. And we have good goals, so we know what actions we have to take. And if you guys all remember, I've always given you guys this analogy of going on vacation and driving, right? We want to go to Palm Springs, we get in the car, we set the GPS for Palm Springs, right? Now along the way, there's detours because of construction, there's slowdowns because of traffic. But we make small adjustments and we still get to our destination on time, just like we planned. We don't hit the first detour or the first slowdown and turn around and go back home. And that's what this time period is. This is just a short detour or a short slowdown. It very quickly can change pace. And suddenly we can see traffic start to pick up and we can very quickly move back to the positive. Now, I still believe that that's possible this year. And there's quite a few people that do as well. Not everybody. So the general consensus is we'll at least finish the year even, if not positive. And I think that's very much likely the case. I think it could be after the elections before we see that move. But we can't say with 100% certainty. So when we talk about the macro world, the macroeconomic world, we're talking about a lot of different variables. And we try to make predictions based on those variables. But there's so many variables that we can't take everything into context. We could have never foreseen Russia attacking the Ukraine this year, and some of the fallout in China from COVID. So those things were unknowns at the time, and now we have to take those into account. But looking at economic cycles, we see how quickly we move through them and how quickly the market rebounds. We go back to 2020, the market dropped nearly 32% in less than 30 days. We wiped out 3 years worth of earnings. That's quite a bit more than what we've dropped so far this year. But yet this year feels different. It feels worse. And I think that that's probably because we've been more tuned into it. We've been more focused on it. We haven't been distracted by COVID and all the other things. But if you think about it, that time was really scary, especially for us, because that was a time that we had never seen in history. And yet we came through it, and by the end of the year, the market had moved positive. So don't underestimate by how quickly we can see recovery happen. I'm not saying that it's going to, but I say that the probabilities are that it will, in the near future, continue to move back to the positive. So we want to focus, again, like I said, on our long-term goals and focus on results. And the results are what we're after. This is not a time for knee-jerk reactions. One of the worst lies to ever be told to consumer investors is that you can time the market. We've never seen Warren Buffett do it. Peter Lynch couldn't do it whenever he ran the Fidelity Magellan Fund. Some of the best investors in the world haven't ever figured it out. I promise you that's not the case. Anybody teaching that or saying that is just out to take you for a ride. If I thought that there was a way for us to improve this situation, we'd be doing it. And we are doing it in as much as we can within the portfolios that we have. So we continue to look out for your best interest. We continue to look at what the overall data is. We continue to look at what the numbers are telling us. We know it's not fun. We know it's scary to watch portfolio values come down. But we've been through this before. We'll go through it again, I can promise. And so right now we want to hold on. We want to keep on with our long-term goal. And we're just going to make some small adjustments to stay on course, to get to our destination on time. If you guys have questions about your individual accounts, or if you need to visit with us, or you're concerned with something, or you hear something that you don't quite understand, please reach out to us. We're happy to visit with you. We're here to take care of you. We don't take this lightly. We look at this very seriously. We're watching this on a regular basis. Know that we are going to continue to take care of you, and if there's something that needs to change, we're reaching out to you. Have a great afternoon.